Let's speculate. So what I was thinking about today was whether the interest rate hike by the Fed is actually the right thing to do at this very moment. We know that sort of with what all the books will tell you is that if inflation is out of control, hike interest rates. That's what the books are saying. But all the books are sort of not based on scenarios where there was an absolutely insane amount of money printed. So, and I think we sort of at a point now where we have to choose the pain. We got two pains to choose. You've got the pain of inflation, or you have the pain of high interest rates. And I think something the American Fed is not really sort of looking at is what is the pain of high interest rates at the moment, like looking at what pain it will cause, looking who will be affected, and then also what will be the pain of high inflation. What's actually going to happen when there's high inflation? And then choosing which pain is the least amount of pain, because there's no good way out here. It's literally we're choosing the least bad thing. So if they do hike interest rates, the people at the moment where we're standing now, the people that you will hurt is not actually the people that's causing the problem. Because as we know, there was an insane amount of money printed over COVID, and that's causing this high inflation. The Fed will tell you something else, but that's just obviously they don't want to look bad. But they made a mistake. They printed too much money. So so where we're sitting now is that a lot of people got money. Everybody got a lot of money. Some of the general population in America got so much money that they were able to quit their jobs, settle their debts. So they basically, their lifestyle has become so much cheaper. And a lot of them are not even working. That's why we've got this work participation drop. And the other part of the coin is the people that sort of they use the stimulus checks to sort of just get by. They're still working. They managed to kill a lot of their debt, but not everything. They're still in debt. The problem is that the people that's making the prices rise, it's causing inflation, are the people that have excessive money. They've got, technically, they can spend a little bit more freely. They can just, have fun. They can live a good life. They actually causing inflation because they're buying goods and services like there's no tomorrow, with other people, the people that are struggling a bit, that still has debts, they are actually not spending. So they're not actually the contributors to inflation. But what happens if you raise the interest rates? Why? Okay, they say, why do they raise interest rates? The reason they raise interest rates is to make the availability of money less. So basically you want to remove sort of liquidity out of the economy. So what they do, it makes it more difficult for you to access money. But the people that's causing inflation doesn't have debts. Because of all this money printing, they don't have debts. So if you raise interest rates, it's not really going to affect them. So you're just making life more miserable for the guy that's already suffering, that's not contributing to inflation. I know we've seen a drop in the inflation numbers, and it's looking good. I don't think the raise in interest rates or the reason it looks good has anything to do with what the Fed expected it to do. So let me explain. The Fed is thinking the reason that inflation is under control is because they've raised interest rates and it slowed down the economy to a degree where inflation became less. But what I think is actually happening is that because interest rates are higher, the rest of the world is basically screwed. Foreign investors are just buying American bonds and American assets because it's the safest place. So the demand for the dollar is actually what So it's not inside the American economy, it's outside. It's the world economy that's actually causing the dollar to be better. So the Fed thinks it's working, but it's not actually working. The only thing they're actually doing is causing pain for the people that's already suffering. And the problem for the rest of the world, so the Fed obviously, their best interest is in America. It's not the rest of the world. But for the rest of the world, the interest rate hike is actually a very, very, very bad thing, because the American consumer is actually the thing that runs the world economy. I know that sounds weird, but the amount of money that sits with the American consumer, and obviously a lot of the money printed was injected into the American consumer. There's so much money there that it's almost like more than the rest of the world all added together. And all the countries that makes goods and services, a lot of the exports are actually to America. And the demand is created from the American consumer. So the American consumer is actually keeping the rest of the world alive. So if you hurt the American consumer, you hurt the rest of the world. And what will happen if interest rates do go up and the people, the consumers that are struggling, what will happen to them? They will start defaulting on their loans. So they'll stop paying their credit cards, they'll stop paying their houses, they'll stop paying their rents, they'll stop paying their cars. So there'll be a lot of repossession. There'll be a lot of people that are kicked out of their homes. So it's like a light, the 2008, but just like a light version, and not just specifically focused on homes. It'll be focused on sort of a lot of asset classes. And that will obviously hurt the consumer quite badly, and as we've heard from the Fed, that they are not afraid to hurt the economy. They like, we don't care, we want to get inflation under control, we're going to just push the lever as far as it can go, and we will break this economy if it needs to, just to get inflation under control. But what's the opposite of the coin? What will happen if they just leave inflation? Let's say they leave the interest rates where it's now, and they just leave it. And they're like, okay, let inflation run a bit. What happens with that? Actually, it's not a bad thing. If you can, because the main issue with the Fed is what they call inflation expectations. That's the bad thing. So inflation expectations is where people expect inflation, so they cause inflation. So that's, if you can keep that under control, then you're actually fine. Then you can let real inflation run a bit. Because what happens when there's real inflation? Real inflation is actually not a bad thing, because what that does is it actually evens the scales for everyone. So the people that have a lot of money, that got excess cash, their cash technically becomes a bit less, right? So they don't, because obviously prices go up, so their buying power becomes less. So they can't actually spend as much. But people with debt is actually better off now, because interest rates go up, usually salaries also go up with it. So now your debt technically becomes less because your salary becomes more. So that the ratio between your salary and your debt is sort of in a better scenario. The other thing that also actually becomes better is if inflation goes up, technically that will mean that the tax generated will also go up. Because if all your prices go up, the amount of tax that the US government collects will have to go up, because the prices, or the actual physical dollar amount flowing through the economy, is more now. But a lot of your social grants will actually go down. I know this sounds a bit horrible, but your social grants, you kind of, in times of distress, you kind of need to spread the pain a little bit. And the problem with social grants is they don't share any of the pain. But if inflation goes up, technically social grants goes down, because the government gets more dollars in tax, but it actually pays less in grants, because the grants are the same. The grants, social grants don't go up, unemployment doesn't go up. So, well, actually, unemployment goes up depending on your salary. So maybe later it will go up, but not initially. So it's actually sort of it's a good thing for the government because they obviously, pay less social grants because they collect more tax dollars versus their social grants. It's a better thing for people in debt because they're better off. So what's the only real issue with inflation is, like I said, the expectation. You don't want to create expectations. And you also, anybody with cash is going to have less cash. If even the wealthy people with lots of assets, they will actually be fine because their asset value will just go up with inflation. So they technically will have the same buying power because obviously they must just not have a lot of actual cash. So I don't know, it just sounds to me like the lesser pain. So maybe the way out of this thing is not actually to try and fight inflation, not where we're sitting now. If there wasn't an insane amount of money printed 2-3 years ago, then I would agree, yes, maybe hiking interest rate a little bit, seeing if we can control it, that'll be fine. But specifically in this scenario where we're sitting now, I think hiking interest rates is, one, not going to fix the problem. You're going to have to hike it a lot to fix the problem. And two, you're going to hurt people that's not actually causing inflation. So there's going to be a lot of pain. You're going to hurt the American consumer quite substantially, and you're going to hurt the rest of the world. Whereas if inflation goes up, well, the rest of the world will actually also be better because, obviously we're all linked to the dollar's the reserve currency, so we're all sort of feeling it equally. So that's just an interesting thought. So you leave some comments, please, if you can think of what's actually, how do we measure the pain between inflation and high interest rates, especially the scenario where we're sitting now, where I think that higher interest rates are not actually going to fix inflation because of the excessive cash in the system. And you're going to punish the people that didn't create the problem. So it's almost like the interest rates and the inflation is de-linked now. They're not actually connected anymore. So that's my thoughts for today. Let me know what you think. Leave a comment. If you like this video, remember to press the button. And if you want to see more speculation and thoughts and all sorts of weird thinking patterns in the future, then remember to subscribe. Until next time, this is Steve. Ciao.